Hey guys, the Bank of England today announced an increase in the base rate of interest by 0.75% to 3% here in the UK. This is the biggest rate rise, a single rate rise since 1989 and the highest level of we've seen in the base rate for the last 14 years. Now, as if this was not bad enough, they also announced that we should expect a very challenging time economically here in the UK. Essentially, we expect to have a recession for the next 2 years, the longest recession we've had since records began. Now, I want to just start off by saying, please do not panic in any way, shape or form. Everything you see on the news and the mass media will be all about making it sound like it's doom and gloom. And I know we're going through very challenging times economically. But what I want to do with today's video is essentially share with you what was announced. I've looked at the minutes of meetings by the Monetary Policy Committee, the guys who are making these decisions. And then I want to just point out certain things that stood out to me from the economic standpoint, this recession is expected, what GDP is expected to look like. Then I want to look at the impact on mortgages, savings, and things like that. Okay. You remember from our last update, only in September just gone, that we had a situation where in that meeting, at the Monetary Policy Committee meeting, 5 people voted a 0.5% increase and 3 people in that meeting voted for a 0.75% increase. And I said to you guys in our last update that this is actually a sign of things to come. We should expect around a 0.75% increase for the next updates. And we've seen that happen now. And this time around in November, 7 people now voted 0.75% as an increase, whereas 2 people voted 0.5%. And they're all doing this in line with what's going on around the world. If you look at the US Federal Reserve, you've seen 0.75% increases. If you look at the European Central Bank more recently, 0.75% increases. So you can see that all these rate setters around the world are all really following the same trend. And the reason for that is because of persistent inflation that's really plaguing all our lives, okay? And they're raising these rates to try to reduce demand, to bring inflation down to the target of 2%. Okay, that's what the Bank of England's aiming for. Now, before I actually go into what's shared, I want to just mention something that's very important to mention, which is that everything that the Bank of England has actually shared actually does not take into account what's expected from the government, what's known as the autumn statement that's coming out on the 17th of November here in the UK. So the Bank of England are in charge of what's known as monetary policy. So looking at interest rates and trying to manage that, to use that to manage inflation and things like that. Whereas, the government, the Chancellor and so on, look at fiscal policy, look at taxes and so on. So what hasn't really been factored in is the impact of what we expect will come, which is that we will have higher taxes and cuts and likely cuts to public spending rather than what we had from the disastrous mini budget that was a few weeks ago. Okay, so with that backdrop, let's now look at what's actually happened. So interest rates, looking at that, the good news, there was some good news actually from the announcements today, is that the Bank of England gave some guidance to suggest that the peak of interest rates will be in autumn next year at around 4.5%. This is the base rate, by the way, not like what we get in the marketplace, which I'll come to in a minute. The base rate, they're expecting to be around 4.5%, which is actually below what had been priced in by the market. So the market, if you think about back to when we had the disastrous mini budget, just after that, the market was pricing in around 6% being the peak around maybe summer, autumn time next year. Okay, now it's looking like the Bank of England is saying to us, well, actually, that was overestimating what things might look like. It might look like around 4.5%. So I know that's quite hard to take in. Imagine, trying to take in the idea of 4.5% being the base rate. But the fact that compared to 6%, it's a bit lower is actually some good news. Now, looking at inflation specifically, one thing that Andrew Bailey said was, and I quote him, he said, "If we do not act forcefully now, it will be worse later on." So this is him speaking to why they had the need to increase the base rate of interest by 0.75%. Inflation-wise, 12-month CPI, which is a consumer price index, which is the measure of inflation, had risen slightly to 10.1% in September is what they had shown, reflecting a pickup on non-energy components such as food inflation and things like that. So different elements of inflation have different rates attached to them. So for example, food inflation was a lot higher at around 14.5%. However, they're forecasting under this November report, given what we're just going through right now, that CPI inflation is projected to fall towards 10% in Q1 of 2023. Okay, so that's the forecast. And they're saying here that this fall is because of signs of supply chain pressures easing and demand weakening, which would make sense because if they're increasing interest rates, a lot more people will be deferring decisions around purchasing decisions, maybe buying homes, houses and things like that. They'll be holding back on that, which would be reducing demand and therefore easing that demand, which is driving up that inflation. They've also said that professional forecasters, again speaking to inflation, responding to the bank's latest quarterly survey about projecting CPI, they see inflation to be around 2.4% on average in 3 years' time. Okay, so around this time in the year 2025, thereabouts, they're projecting that it will be around 2.4%. We'll have to wait and see if that becomes our new reality. So that's inflation. Now let's look at the recession that they talked about. So they're predicting the longest recession since records began, since over 100 years ago. It will last for around 2 years and it will be painful from what we're being told. Another point they made was that unemployment is set to nearly double on the back of this recession. Looking at GDP connected to this recession, they said GDP is projected to continue to fall through 2023 and 2024, H1 of 2023 and 2023 and 2024 H1 period, as high energy prices and materially tighter financial conditions weigh on spending. Okay, so essentially, in simple terms, we're going to be seeing declining GDP essentially for at least the next 12 to 24 months. That's what's expected to happen. But, let's just, step back for a minute and put a lot of this stuff in context. I don't know about you, but I already feel like we're in a recession. And I kind of feel like, a lot of these announcements are great, kind of confirming what we already know. In fact, I'd love to know from you in the comments if you already feel like, boy, I actually thought we were in the recession already. Yeah, so essentially what I'm saying here is although this might sound very alarming, do not panic. The key thing is to stay calm. And as I've always said with all these updates I present here on our channel, is for us to stay practical and take action across various areas of our lives. So really focus on essentially being forward-looking and taking action, not making any knee-jerk decisions, any kind of random decisions on the back of headlines, but really being pragmatic and acting based on the information that we're receiving in a calm and sensible way. So to that end, we've made a video previously on how to prepare for a recession. In that video, we're going into great detail on some of the practical, everyday things you can do to start to prepare for a recession. I'll link to that below as well as above for you to go and check it out if you've not seen it. Now, of course, there's always, two sides to a story. And with every recession, if you go back and look at history, certain people, not everybody, certain people have found ways to benefit. Because whenever there's stuff going on in a negative perspective, there's always an opportunity that exists as well. So this recession will not be any different to other previous recessions. So essentially what I'm saying here is there will also be opportunities that arise in this season. There could be small opportunities or big opportunities. But the key thing, as I mentioned, is to be calm and open up our minds to possible opportunities in this season, whilst obviously managing our lives financially to navigate the challenging economic outlook ahead of us. So in addition to the video I mentioned around preparing for a recession, I've also made a video to help us essentially look out for any opportunities that might exist in this season as well. So I will link to that below and above on a video we made specifically to help you look out for opportunities during a recession. Now let's look at mortgages, okay? If you are on a fixed mortgage right now, the changes in interest rates, the rise in interest rates will not affect you straight away because you're fixed. However, you will see a massive increase in your mortgage payments as soon as you come out of that fixed rate, because you're likely on like 1 point something or 2 point something max, and then as soon as you come out of that, you'll be hitting like 5 point something percent potentially. Okay, so my suggestion, if you're currently on a fixed rate right now, and we've been saying this for ages, but it's even more important now, is to start overpaying on your mortgage if you can. So not everybody can do that, but if your budget allows it, please overpay, because the impact of compounding will hurt a lot more the minute you come out of that fixed rate and you start to experience a much higher mortgage rate, interest rate. Okay, so that's the action point on that. If you are on a variable rate, so here I'm talking about standard variable rate, or trackers, for which there are around 2 million households on those rates right now. If you're one of those people, you will unfortunately feel the pain of the increase straight away. So according to Money Facts, the current average standard variable rate is around 5.4%. Now you might be thinking, hang on, Ken, that's very different to the 3% you mentioned before. The reason for that is because what we're given as the base rate as an announcement is different to the market rate, because banks, mortgage companies have to add a bit of a margin on top for them to make money from actually borrowing money and then lending money to us as the borrowers. Okay, so the headline rate at the moment is around 5.4%. Now, if you're on that standard variable rate or tracker, you will see that extra 0.75% passed on to you by your mortgage company. So let's look at it in monetary terms. Let's say, use an example of a mortgage, someone who has a mortgage of £250,000. And I know that's more than the average, but there are people out there with that much as a mortgage. If you have that right now and you're off, and let's say the rate was 5.4%, as I indicated, as the market rate that people are getting on 2-year variable rates right now, yeah? What you'd be paying in that scenario would be £1,520 per month. Now, if you add on the impact of the 0.75% increase of the base rate, it would increase that rate from 5.4% in the marketplace to 6.15%. Doing that will attract an extra £114 per month, because the monthly payments will become £1,634 per month. So £114 per month additionally, which someone now needs to go and find for somebody on a £250,000 mortgage. Now, this, of course, will vary depending on how much you're owing and stuff like that. So if you want to work out how much this will impact you specifically, depending on how much you're owing, we've got a free mortgage calculator, which you can download, use and own, just play with it, put your numbers, put your rates in to see how that works out. I'll link to that below and above for you to grab it and start to use it for your own scenarios. Now, if your fixed rate mortgage is now coming to an end shortly, you may actually decide, you know what, I might actually stay put on a standard variable rate in the meantime, because you're concerned that getting a fixed rate might be at a peak of things. You might be saying, well, actually, the rates have risen so much, I might want to sit this one out and just wait. Okay, so if you did do that, you might get a lower fixed rate as time passes over time, because the mortgage markets have been in a bit of a chaos in the last month or so, and things are starting to ease off. However, you will feel a lot of pain right now with the persistent increases in these base rates by the Bank of England. So it's a question of weighing up, do I want to feel quite a lot of pain right now and then hope to gain later for the long term? That's a personal decision you might want to try and focus on making. However, if you're someone who's planning to get a fixed rate right now, it might actually work in your favor because, again, that volatility in the markets over the last month has eased. Okay, so in addition, the current fixed rates, as a result of all that easing happening, you might not actually notice a significant change in the fixed rates that exist right now, because the fixed rate deals that exist right now would already have priced in the impact of the Bank of England's increase of the base rate by 0.75%. Okay, so it might actually work in your favor actually doing it right now and trying to potentially get yourself a fixed rate deal if you can. That's in that scenario. Now let's look at savings specifically. So although we've seen this rise in the base rate, and you might expect your bank to suddenly go, give you that big tick in your savings, the savings, the rate you get for savings, depositing your money. the reality is that it will likely remain as business as usual. You will likely not see that rise happen when you make those deposits. Why? Because a lot of banks already have a lot of, cash available because, they've got access to our cash, right? So they'd have to really, go out of their way in a way to actually have to increase base rates significantly to attract new money. So it wouldn't really be in their interest to increase those rates to attract new money is what I'm trying to say to you. However, if you have those smaller banks, challenger banks, those more digital banks, it might be in their interest to try to increase rates to attract more deposits and so on. So essentially what I'm saying is if you have your money in a normal high street bank, you're unlikely to see any material changes in the rate that you might get for savings. You might see some changes, but nothing by way of the increases we're seeing in the Bank of England's base rate. Okay. The other thing to mention is that thinking about savings, remember I said to you that there's a peak that's expected in interest rates sometime in the autumn of next year. So if you're really thinking about locking away your money and fixing it and stuff like that, you might want to make that decision sooner rather than later because you'll be locking away your money potentially for a year, and savings rates are always looking forwards. Yeah, so you want to try and get in there if you're going to do it. Get in there as soon as possible to attract those rates if that's what you want to actually go ahead and do. And I should mention, obviously, with savings rates, although you might be getting a fairly decent rate from a bank, obviously note that from a real perspective, a real return perspective, given inflation rates far outstrip rates you're getting for savings accounts, the purchasing power of your money is not really doing very much. You're not really getting the return is still negative in that sense. So with all that said, here are my personal thoughts on everything that's kind of going on right now. I'd say if I had to summarize what I'm seeing and how I'm thinking about things, I'd say for most borrowers in this season will be okay in a way, okay-ish, because, stress tests would have been carried out by banks to prepare us in a way for these circumstances. Okay, so people will be okay in some ways to navigate some of the storms of the moment. However, new borrowers, people who are like, I want to go into the property market, I want to borrow more money, there will be a tougher time for those people because the stress test will be a lot more stringent. So where the bank might say to you, oh, you can borrow this much money, suddenly they call you back and go, well, actually, no, you can't borrow that much money. You now can only borrow this much, a much smaller amount of money. So there's that to consider. Another thing that I'm seeing ahead with the talks about a recession and so on, and this should not in any way panic anybody because it's not anything new, is that with every recession will come potential job losses. So even the Bank of England has announced that they expect to see the rate of unemployment nearly double over this 2-year period over which they're expecting this long recession to happen. So I'd say personally that this is not a time to panic. I think if anything, this is actually a time to focus on working smarter rather than working harder per se. Okay, so it's about really thinking about what you do with your time, how you're building more trust through your work, different ways you're exploring to actually generate more income, and a key thing over the next 24 months will actually be cash flow. The degree to which you're managing cash flow and you're seeing cash flow, and the degree to which your cash flow is increasing over the next 24 months. So putting every effort into making sure that you are, managing your cash flow properly and that you are seeing that cash flow increase over time. Okay. And the next thing I want to say as I wrap up is that with all the news that will follow over the next few months, please don't panic. And I've said this before, don't make any knee-jerk decisions, any kind of, random decisions. Just be calm over this period and really focus on, the things that you can control and surrounding yourself with people who have a positive mindset, because that positive mindset is what's going to be necessary for getting us through this season, whilst obviously remaining practical and pragmatic with our finances. Okay. In terms of key dates for the future, 17th of November is when we expect the next autumn statement. So this is looking at the Chancellor and fiscal policy, taxes and, public spending and things like that. So we expect big decisions to come, and there will definitely not be any tax cuts. It will be tax rises expected. So watch out for that date. And the next date for the interest rates update is the 15th of December, when we expect that next interest rate rise to happen. Okay. But I'd love to hear from you guys in the comments. How are you reacting to this prospect of interest rates rising now, the base rate to 3%? And what questions have come up for you from watching today's update? Please jump in the comments and let me know. But other than that, thank you guys for watching, and I look forward to seeing you on our next update. Please, I appreciate you if you're new to our channel. Also subscribing if you enjoyed this particular update. All right, take care. Much love and bye for now.